Welcome to TheoTrade. This is Don Kaufman. It's May 26, 2018. You are watching the Theo Weekend Update. And of course, enjoy the Memorial Day weekend. We've got a holiday on Monday and are coming into a 4-day trading week. With that, one thing I want to mention right up front, very unique week coming for those of you that do trade some options. The SPX options will offer 4 expirations next week. You think to yourself, well, how is that possible? Well, typically, week-to-week basis, we're already seeing Monday, Wednesday, and Friday expirations. Well, when there's no Monday, because of Memorial Day, they'll actually push the Monday expiration to what? To Tuesday. So we've got a Tuesday expiration. Then we get our typical Wednesday expiration, but wait, there's more. Then we're gonna have a Thursday expiration. Why? Because there's end of month options in the SPX. So now you've got your Tuesday, your Wednesday, your Thursday, and of course, Friday, end of week expiration. So many of you that have joked for years about having daily options expirations, you got it this next week. Which brings me to a point that I brought up a little bit earlier in the week on some videos. You know, scalping options on an intraday basis has been rather phenomenal. I mean, we're looking at the SPX. You can go out, you can buy an option for maybe $4 or $5, right around a 50 delta. For those of you that do not speak options geek, that means the at-the-money options. These options might run $5, but you're getting, you know, 10, 15, you know, even $17 movement on an intraday basis. And therefore, the risk is kind of worth the reward. But we'll come back to that in a few minutes when we take a look at some of the charts. A few things I want to discuss this week. First of all, well, let's start with the S&P futures and discuss 2731. It's one of the gravity points that we picked out a few weeks ago, and it's just been, you know, it's kind of a, in terms of a trader myself, like my own worst nightmare. You know, I'm sitting here and I'm like, well, you know, listen, I am long duration bearish, but I like to trade on an intraday basis. Okay, and each and every day when you're just like, 2731, you know, you get to the point where we've even got, you know, a joke that every time we hit 2731, drink. But it's gotten to the point of a little bit of insanity, if you will, talking about 2731. Well, thankfully we closed a little bit below 2731. Now, there's an interesting standout coming in this next week, right? There's not much to talk about in the previous week of trade. You know, we laughed, we cried, we ended up basically a few points away from where we were in the previous week. Here's the interesting aspect that I'm looking at. So when it comes to evaluating the market for this next week, forget about news, forget about what you think is going to occur. Look at the options market, specifically in the SPX. So here we are once again talking about the SPX. Why? There are literally billions and billions of dollars traded in the SPX on a day-to-day basis. There's phenomenal amounts of risk. And the options marketplace is kind of dictating, okay, the forward future of risk. It's what the marketplace expects risk to be. It's not some market maker with a dial like, turn up the volatility, turn it down. It's just buyers and sellers. You know, the word volatility gets all, you know, misconstrued. In the end, volatility, what is it? It's supply and demand. And people are buying and selling options. And the interesting aspect is in this coming week, the volatility is dictating about a $33 expected move. Well, so why is that interesting? We're looking for a $33 move higher or a $33 move lower. What's interesting about it is the previous week, we had a $33 move. The week before that, we had right around a $33 move. Why is it interesting for this next week? Because we only have 4 trading days. So we've seen lower and lower volatility in the markets, implied volatility, and we're actually seeing lower movement, which is what we call historical volatility or realized volatility. So the last few weeks has actually brought us to lower volatility. But the implied volatility in the SPX is not backing down. Here we have 4 days and a $33 expected move. And you got to look at this and say, why? Right? What does the marketplace anticipate that we're not necessarily thinking of? I look at it a very different way. I don't think this market is necessarily anticipating something. I think it's telling you, and this is the way I view it, is you need to get and stay on your game. And there's a few points that I'll make. You know, so we have lower implied volatility in the marketplace, but again, this expected move stays at 33 bucks. The actual market is moving less and less. But if you look around, forget about the S&Ps for a second. Forget about, you know, your Google, forget about your Tesla, forget about individual products. The markets and global markets, people, they're on the move. You're like, well, what's on the market? All right, and what's really on the move? Bonds. Bonds are ripping right now. Turned around after seeing some heavy sell-side activity. They ripped this week. In fact, the bonds, I'm looking for them to get back up to, and if you don't speak bond language, about 144, 145 is where I'm looking for the bonds to kind of peak out in this most recent rally. Now, those bonds ripping is going to cause a little bit more pressure to the financials. But again, let's not even look at that right now. When I say the market is a moving, bond market is moving right now. What else is moving? The dollar. What else is moving? Emerging markets. Markets all over the world. Latin America. Okay? These things are on fire. Not enough people are paying attention to it. Okay? We want to keep a very, very close eye on emerging markets. Want to keep a close eye on the dollar. Quite frankly, when it comes to the dollar, purely opinion, I think we maybe peaked out for the time being and might start to see some sell-side activity. If we don't, that strong dollar is just wreaking havoc on emerging markets, and they're just snapping left and right. I mean, you got markets, for example, over in Italy, debt markets that are they're on watch to be, downgraded to junk debt. Everywhere we're looking around the world, we're seeing signs of volatility. But the SPX is, completely and totally snoozing there at a $33 expected move for the week. Let's get over here to the charts and take a much more detailed look at a few aspects of today's markets. All right, let's get to the charts and start with the SPX. Zooming in on the most recent weeks, this is exactly what I was talking about with these $33 expected moves. So we've got one, we've got two, and here comes the next week, 3 weeks in a row, right around that $33 expected move. Speaking of which, if at any point in time, if you want to check out kind of previous expected moves, and this is some data that I not only do I draw it on my charts, we do have a study here at TheoTrade for auto expected moves, but of course we can share these expected moves. We can share the auto expected moves. For those of you unaware, we share everything here at TheoTrade. It's literally a shared link away, even when it's studies that we've built or have had clients build. But also, if you want to check out expected moves that have happened in the past, specifically on thinkorswim, you go to the Analyze tab and you come over to what's called Think Back. Now, Think Back is just end of day data, and they've got, almost 2 decades of it. What you can effectively do is just click open this calendar and cruise back, for example, to like last Saturday. So all I'm doing is pulling up data for last Saturday. You kind of look at the week at large. So from last Saturday, you can see there was right around a $33 expected move. And then you can just drift right back, to the previous week before that. Maybe we cruise out to the 12th. And I just look from Saturday to Saturday. It just makes it, I believe, a little bit easier. And you can see right there is about a $33 expected move. It's just a great way to kind of, recount what is going on, what has gone on, and what some of those expected moves happen to be. Now, with that, this is what I was referencing in the video component, and that happened to be there's a Tuesday, there's a Wednesday, there's a Thursday, there's a Friday. We got weeklies turned into dailies, and once again, there happens to be effectively our $33 expected move. And why that's interesting is you only have 4 trading days in there. Now, to move on, okay, let's go over and let's establish a couple of levels, and then we're going to talk about what I would term some volatility in the greater marketplace. And I just don't think enough people are paying attention to everything that's going around, the world, because it doesn't impact them. Most people, even traders, they get myopic, they get very, very passive, and they're missing the larger picture that the market isn't necessarily the S&Ps, or the market isn't about, the financials or just Google. Okay, world markets are seeing a little bit of turmoil, and we're going to show you that here momentarily. Before that, though, let's get to the S&Ps, and one of the ways I really like to look at the S&P futures is not in this expanded 9-month, kind of one day. I like to kind of zoom into like a 30-day, 1 hour, okay, just to get a feel for what some of the recent trade, okay, tends to look like. And you can see this is going back right here, right? When I say right here, we're going back to right around May 9th. So we've had about 3 weeks where we're just channeling from 2,700 right to about 27, of course, 40. It's a 40-point range. We're trapped like a hamster inside of a wheel over here. in a very, very tight trading range. And this is where I was saying, so the historical volatility, all right, which is the annualized standard deviation of the past stock price movement, what that effectively means is how much the market's moving, okay? The market right now is moving less. So we've actually had historic volatility kind of contract down upon us. But the interesting thought on this is at the same time that the actual market is moving less, the implied volatility is not, okay, decreasing. And that's where I was showing like these $33 expected moves over in the SPX, because you kind of compare and contrast and you're like, hey, it's fairly interesting. Why isn't the risk, okay, moving forward contracting? And I don't have an answer other than to tell you, stay on your guard. And I believe that a lot of this has to do with some of the emerging market risk that's going on out there. Now, need I mention levels once again, but one of the key levels on your screen over here is none other than 27.31 down below. I don't want you guys to get off your game. You want to look at 26.82 extensively. And frankly, do we have any levels above this? Okay, because that's one question that will come up periodically. These gravity points take a very long time to be able to effectively identify. But I'm telling you, once we've actually got identification of a gravity point, and I've probably already had 50 emails like, well, could you build a study to find gravity points? And the answer is no. This is not some Fibonacci, some Bollinger Band. This is looking at intraday trade and deciphering at what points huge trading firms either have risk or not have risk. And at 27.31, okay, that is a warm, fuzzy spot for a lot of big trading firms. And when you start to get above it, markets could, clearly explode to the upside. You start to get below it, and they'll dynamically hedge us back down, to lower levels. The only level I have that is above this is substantially above this, right off almost the all-time high, which is 28, about 42. Right in that neighborhood. Again, below where we're currently at, which is right around 27.31. Again, we have 26.82, and even below that, right, also a very, very critical point, which is 26.26. If you guys do not recall that, we were screaming that one at the top of our lungs for quite some time. For those of you that do not remember, we actually traded 26.26, similarly to what we're doing at 27.31. All right, to the bigger picture now. And what is that bigger picture? As I said, everybody's looking for volatility in a marketplace. You don't have to look that far, right? So let's go take a quick glance at the bonds that I mentioned a moment ago. And the bonds, these things exploded to the upside. What's that doing? It's taking interest rates down. Now, you can look at this a number of ways. Right? I think a lot of people would probably argue that we were in an oversold situation, okay, and we're just bouncing back. I don't necessarily disagree with that. And again, I'm not a big market technician, but I don't want to get into this as overbought, oversold. Okay, here's my reality, being a trader, and if you just listen to the rhetoric out there in the marketplace, listen, everybody pretty much and their brother is short bonds on the professional side. What does that mean? Everybody's short bonds, one of the most crowded trades in the entire industry. No wonder, the first person covers and we explode back to the upside. However, okay, I believe this is actually going to be short-lived. As I was saying, okay, I believe that we're probably going to cruise back into this kind of 144, maybe 145 kind of region, right in this neighborhood here. And I'm going to look to take a defined risk position. All right, and that defined risk position would be to the downside, because this may be the bonds making a nice hurrah back up, but there's no question about it. I think there's still going to be some pressure because we do have an FOMC meeting coming up. I think they're going to change a little bit of the rhetoric in that FOMC meeting just a few weeks out. So you're looking for volatility. You don't have to look much further than the bond market. If you're not comfortable trading like ZB, all right, look at the TLT. All right, get comfortable, people. Now, the other thing that's got quite a bit of volatility in it is none other than the dollar. The dollar, I mean, this move just, it's explosive. Now, people ask me constantly, do I trade a lot of currencies? And the answer is no. I really do not trade myself a lot of the currency products. It has nothing to do with like a love-hate relationship with the product itself. It's everything to do with the fact that sovereignties okay, come out, for example, China can come out and devalue the yuan instantly, and it would just, rip your trade apart. What I like to do is I like to look at the currencies, okay, evaluate that currency, and make my trade based upon what I think this currency might do, make the trade based in something like the emerging markets. Just makes a lot more sense to me. I think it's much more controlled risk. The currencies make a ton of sense to me, but I don't like that sovereignties just pop out of the woodwork once in a while and be like, look, we devalued our currency. Or what they're doing, for example, someplace, like Turkey, where they're changing, all right, by the way, the Turkey getting decimated, their currency is getting decimated, but they're changing the interest rates to try to offset that. And the change of interest rates there, okay, not a great example necessarily of it moving the US dollar, but as other countries around the world change their rates or they can impact their dollar, it has a definitive impact here on the US currency. So I would rather play out that trade somewhere inside of something like EEM and emerging markets. Nevertheless, getting back to the dollar here, you see the dollar exploding to the upside. Okay, I have and continue to believe that there's going to be a little bit of a retraction in here. I mean, people, this thing hasn't halted, but for what, 2 days? Okay, the move at some point becomes absolutely devastating, all right, to emerging markets, right? And you really start to think back like, is anybody going to start fighting this move? Are we just going to shoot right back up here to 100? I mean, listen, this thing is what I would call trend-worthy at this time, but this is the 3-year chart. And you can see the dollar over many years. When this thing gets rip in one direction, it does not stop. All I'm doing right now is looking for like a short-term pullback before it rips back to the upside. But what that's effectively doing, look at emerging markets. Okay, the pressure into emerging markets, and I'm telling you, I don't think the emerging markets is done, and this is where I want my trade to play out. I'm looking for a bounce up in emerging markets, okay, and then a big time short to the downside. That is pressure to the emerging markets. Emerging markets getting under that 45 level be devastating. So, if you're looking for volatility, right, where do you want to go? You want to go to the bond market? Do you want to go to the emerging markets? You want to get really crazy? Why don't you go look at something like Brazil? So I know this is a 3-year daily, but we'll take this into the a 9-month daily. Brazil, this thing is absolutely wild. And one of the reasons I'm showing you EWZ is because there's enough liquidity to get stuff done in here. Like, I don't want you to think that you can't trade this product. Just go over here to like volume and open interest. Okay, there's enough liquidity and enough professional trade to get stuff done. So if you're having trouble right now thinking like, there's no volatility out there in the S&Ps, first of all, just wait. There'll be volatility because emerging markets, especially like Latin America, when Latin America starts to have some issues, okay, believe me, that volatility is right around the corner inside of the S&Ps. Nevertheless, when you're looking at something like EWZ, okay, here's the trades that I'm looking for. Once again, similar to the emerging markets, this thing has gotten pummeled, okay? One of 2 trades. You want to go after a bounce trade, do it, but do it with defined risk. Use something like an in-out spread, bounce to the upside. After a decent bounce to the upside, step in front of the freight train, re-short it. How do you do it? As I said, use things like in-out spreads. Don't get cute. If you're looking for a bounce trade, go out there and purchase like a $2 wide spread for right around $1. And, listen, this thing has got tons of strikes on it, okay? Build it to your heart's desire. Here, look, this is a $2 wide spread for a 93-cent debit, okay? Be careful, be defined risk in a marketplace. Again, this is EWZ, 31%. I mean, that's like the VIX being at like 31%. You're looking for volatility, but you don't want to deal with a Tesla. You don't want to deal with Google or Facebook. This is a pretty good place to find it. That would be kind of your bounce trade for the next 20 days in there. Again, as I said, emerging markets around the world. Take a look at Turkey. By the way, this is not per se a liquid underlying. This is not something I would trade options in, but I did want to show you, okay, a little bit of volatility inside of a marketplace, and it's right there. Speaking of ETFs, and this is another emerging market ETF here. But speaking of ETFs, one thing that really comes to mind in the last couple of trading sessions, and I'll kind of leave you with this thought on this weekend update, is there's as many ETFs, even more ETFs now than there are equities that you really want to trade. Meaning that like the liquidity in ETFs isn't all that wonderful. Now, there's a ton of spectacular ETFs, the emerging markets. Right? Look at the emerging markets. This thing traded 190,000 contracts, and you look at the spiders, and you look at the IWM, and you look at the Qs, and you look at something even EWZ. I mean, I can go through a few dozen ETFs that have got liquidity. But one of the issues that I've got right now with the overall market, forget about ETFs, forget about the dollar, forget about everything for a second. One of the issues with the overall market that's really going to impact, the entire marketplace is we still haven't seen, in my opinion, real bouts of volatility. And the liquidity out there is beyond poor. The liquidity is a bunch of passive, investors that just sit there on their hands and they don't do anything in the marketplace, mixed with a couple of traders. But one of the things that we're noticing in a lot of the recent trade is that there's cracks in liquidity showing up everywhere. People, there will be a substantial volatility event coming, all right, in the near future. Liquidity is poor. We've had, again, suppressed volatility because of Fed intervention. They're now actually pulling the rug out. Now, I don't want to leave you with, a not so happy thought over the weekend, but to me, from a trading perspective, this is what makes me warm and fuzzy. This is what makes me want to be involved in this marketplace, because undoubtedly, that volatility in the S&P, once again, is right around the corner. Have a wonderful weekend, everybody. Bye-bye.